Chapter 14.1, Estimating and Journalizing Entries for Uncollectible Accounts Expense. So as we move into 14, we're starting to talk a little bit about some managerial decisions. And one of your first managerial decisions, I don't know if it's the first, but one of the more common managerial decisions is to estimate for uncollectible accounts expense. So in a perfect world, up until now, our accounting world has been pretty perfect, meaning we have sold services on account and we've received cash on account. But what happens if a company cannot or doesn't pay you? Is this realistic to expect? Should you expect everybody to pay you 100% of the money they owe you? The reality is it's not going to happen. So you do have to forecast for what is called uncollectible accounts expense, or basically bad debt. Um, Companies, like I said, must forecast. Now, the percentage that you use oftentimes will be used on historical numbers. The percentage that you use on a monthly basis will change depending on seasonality, depending on the current market environment, the economy, et cetera, et cetera. So, again, this is a forecast. Kind of think of it as like the weather forecast, but for accountants. It's probably the best way to. So, because we are going to forecast, we have to introduce a new account. And our new account that we're going to introduce is the allowance for uncollectible accounts account. And this is a contra asset account. It is designed to lower the book value of the asset account. And in this chapter, we're going to use the accounts receivable account for the asset account. If you want to look at it a little bit different way, if you take we talk about what book value is. If we take our accounts receivable, we subtract it from our allowance for uncollectible accounts. Again, those are both balance sheet accounts, and we'll get our book value for accounts receivable. If you do look at a balance sheet of any business, they will forecast and will have their book value for accounts receivable in there. Their book value, again, will show the reality of what they're owed, but yet what they expect to maybe not receive. Now, again, it's going to be different per industry. Some industries will be higher, some industries will be lower, but it's important to forecast for that because the reality is you're just not going to get all of your receivable that you pay. So how do you estimate for it? Well, there's two methods. We have the percent of sales method. That assumes that a percent of credit sales will become uncollectible. So you can take your total credit sales and you can take them and you can your total sales. Again, this is your sales, your credit sales. You can take it and say, well, 1% is not going to be collected, and that's the way you do it. Then you have the percent of accounts receivable method, which is an analysis of the accounts receivable to estimate it. Now, when we talk about that analysis, one of the things that we get into is we get into the aging of accounts receivable. Most businesses will group accounts in 30-day periods, such as 31 to 60, as you kind of see here. Um, the percent that you use, if you notice there, that's the likelihood of what we don't expect to return. Now, one thing you can notice in this chart here is if you're current, meaning everyone's paid up in full, it's not 100%, it's 2%. This is based on historical figures, but again, it's going to happen. And notice the older that they get, in other words, the longer they are past due, the more likelihood of them not collecting. So we kind of have to forecast for that rainy day. And that's what this will show you here. So one of the ways that we do that is basically we compute the estimate for each age group by simply multiplying the amount of each age group by the estimated uncollectible accounts expense. So in this case, I'm going to take my 2489. I'm going to multiply that by my 2%, and I'm going to get an uncollectible account allowance of 40978, which basically means out of this $20,000 that I am in my accounts receivable, I'm expecting not to receive 409. Now, could that be higher? Yep. Could that be lower? Yep. Could that be dead on? Yeah, absolutely. But again, remember, this is a forecast that we're looking at here. So then I would complete this process for the remainder of those, and I would take the 164720 times 6%, et cetera, et cetera, et cetera. I would add them all up, and I would get my total here. Now that total will represent the allowance for uncollectible account, what I'm kind of forecasting. And again, this could be on a monthly basis. This could be on a yearly basis, depending on the industry that you're in. Like if you're in the financial industry, you're doing this every month. You're really looking at this every month because that's kind of your business when you think about accounts receivable and loans and mortgages and all that stuff. So then you add them up. Now, in your directions for this example, you'll notice that you were given an amount. I'm not going to give it to you here because I'm going to have you referred in there, but you're given the amount. So we take my total, given my amount in the directions, and if I subtract A from B, I will get my estimated addition to the allowance of uncollectible accounts. Think about this math formula, this A minus B. If you have 5 Skittles and you know you need to get to 15 Skittles, you're going to add 10 Skittles to the pile. The estimated addition to allowance for uncollectible accounts is going to be your 10 Skittles. So that's how you kind of estimate the uncollectible accounts expense. So now let's talk about making it official, because as of now we haven't made it official. So we make it official when we put it into a journal. Now, here's an example for you. Kellogg estimates uncollectible accounts of 1%. Again, using this is your credit sales example here. During the account, it's really no different, just less of a chart. During the current year, Kellogg has credit sales of 3.426 million, and the balance of uncollectible accounts before adjustments is 534 on a credit. Record the uncollectible accounts adjustment on the worksheet. Should say journal, but my error. So again, we're going to take my total sales on account times my percentage, and I'm going to get my estimated uncollectible accounts expense of 34,260. So now when I'm entering these, I have to enter these in. So we know my first account that I'm going to use is my allowance for uncollectible accounts. Again, that's a contra asset account, meaning it is designed to lower the asset account. So therefore, since it's designed to lower the asset account, allowance for uncollectible account is going to have a normal balance of a credit. It acts opposite of an asset account. Okay, so I go to my journal entry and I'm going to write adjusting entries because this is an adjusting entry. I am going to then put the date. In this case, the date of the example is the 31st. And I am going to start off with my debit and my credits. My debit for this one, as you can see over here, is my allowance, uncollectible accounts expense is going to be my debit, and of 34,260, and then my credit will be my allowance for uncollectible accounts. Now, when you think about this, and this kind of goes back to the beginning, is this actual money going out of the company with this expense? Nope, not yet. But it's also not revenue coming in. Now, you also may want to look at this and go, well, wait a second, why are we not just going to credit the accounts receivable? That's a great question. And the reason we don't credit the accounts receivable is because, remember, we're forecasting here. This allowance number could be right on, could be higher, could be lower. And again, if you also think about it, and I'm previewing up further chapters, this transaction here is going to impact both, going to impact a minimum of 2 of our financial statements. This uncollectible accounts expense is going to impact our net income, and this allowance for uncollectible accounts is going to impact our balance sheet. So that's why you use those. So then when we're done with that, we get to do everybody's favorite thing, and this is you get to post these items. I know, control your excitement. But I'll just walk you through it. And again, we take the date. This is basically just copy paste. We take the date, which in this case was December 31st. We then go to my uncollectible accounts expense column, and I'm going to use that G25 as I'm getting this from journal page 25. My debit is going to be 34,260. Now I have a 0 balance plus 34,260 debit, so therefore 0 is going to give me a debit balance of 34,260. And to complete the process, I'm going to go 6165 up in my post reference. I'll repeat the process for the allowance for uncollectible accounts. As you see, my 34. Now I have my post reference, which is going to be G25. Now in this case, my allowance for uncollectible accounts is a credit. Now we get a little bit unique situation again, as I have my credit. I have a credit balance of 534, and I'm adding a credit for allowance for uncollectible accounts of 34,260. So a credit balance and a credit entry are the same. So therefore, we're going to find the sum, and we're going to add them up, ring them up to get 34,794. And then the last part of my process that I cannot forget to do is kind of put my bookmark of 1130 back on there. That's it. That's 14.1. Hope this helps. Let me know if you have any questions.